Welcome, everyone. Insights, the name of the program with Bob and Mike. Bob Wright, 206-619-3274, 206-619-3274.
And I am Mike Walsh. I can be reached at 310-383-1570. That's 310-383-1570.
Hey, if you need an estimate of value on your building in this crazy market, nobody has more experience. I've been through a half a dozen of these cycles. Our guest today is Kelly Yates of Exchange Facilitators. We had a very informative Q&A session with Kelly, asking him the questions that I get from clients. And one of those questions, something many of you may not be aware of, you can take your partnership and restructure it so that the individual members of the partnership can go out and do their own separate exchanges. And we'll pick it up there with Kelly's answer.
So a partnership as an entity can do an exchange. Any taxpayer, whether it's a corporation, a trust, a partnership, a limited liability company, they can all do exchanges at the taxpayer level, at the ownership level of the entity. But you cannot exchange entity interests in a partnership, or entity interests in a corporation, or entity interests in an LLC. And in the case of a partnership or an LLC, you can create a tenancy in common so that the former partners or members can become direct owners of the real estate. And that's the strategy for allowing the members and the partners to exchange separately. Generally, that is just a distribution deed into the members' names, the partners' names, lender consent if you have a lender, which can be problematic. There aren't usually any tax consequences to doing that. And then after you've created the tenancy in common, you try to season that for a while at the tenancy in common level before you sign a listing agreement or a sale agreement. The extremely conservative advice is to season the ownership at the tenancy in common level for a year. Very few people do that. Typically what happens is, I get a call and they're under a listing agreement or about to accept an offer. And so we're kind of scrambling to create the tenancy in common at the last minute. But that's how you deal with different members or partners who want to go their separate ways. It allows them to separately sell or exchange. Now, there are some entities where you can't do that. For example, a corporation, you can't do a tax-free, liquidation of a corporation. So if you own stock in a corporation that owns real estate, you can't create a tenancy in common because the act of doing that, it triggers the taxable event. So there are, in the case of a partnership or an LLC, or even some trust, you can do that. You can create a tenancy in common and then again season it with the idea of exchanging separately. Now, the other approach that I see, occasionally is you exchange at the entity level. Let's say you have a two-partner partnership and the two partners get along very well, and it's a 50-50 partnership. And and they're making the decision to go their separate ways at the last minute. One option is to actually exchange at the LLC or partnership level and buy two replacement properties, one that each partner wants, and then hold them at the LLC or partnership level for a period of time, 6 months, a year or longer, and then dissolve the partnership or LLC and distribute, one asset to each member or partner. That's an alternative strategy that you occasionally see, especially with partners that get along well. I guess that's not a very good, strategy. It's not a good strategy if one partner wants to sell and the other wants to exchange, or if the partners don't get along. And it certainly creates some lending issues on the back end. If you get loans, you've got, due on sale issues and probably guarantee issues on the loan documents.
But you can convert into a tenancy in common after the listing has been taken.
You can. You try to create the tenancy in common before the sale agreement's entered into. The worst set of facts are signing the sale agreement at the LLC or partnership level and then trying to create the tenancy in common. Now the courts are by and large very taxpayer friendly when it comes to that set of facts, and the likelihood is you probably wouldn't get audited, but that has historically been a hot button for the IRS if you try to create a tenancy in common or a partnership after the sale agreement has been entered into. Now, having said that, I see it all the time. I've seen tenancies in common created on the day of closing before the sale deed is recorded, but that's just not, I mean, a lot of the people doing that are prepared if they, get audited and challenged. But again, by and large, the courts are very taxpayer friendly when you're creating a tenancy in common, even after the sale agreement is entered into. It's just you've got more litigation exposure if the longer you wait.
Sure.
If you ultimately do get audited.
Michael had a question from one of his clients. In fact, you had done this for me.
Yeah, Kelly, talk a little bit about it. If you're exchanging into a building that requires some renovation, can funds be set aside or proceeds be set aside for that rehab?
It's difficult. If there's not a loan involved, then sure, you can do it. Typically, the qualified intermediary or the exchange company sets up a special purpose LLC and takes title to the replacement property, and then holds the replacement property during the 180-day period, enters into the various agreements to improve the property and doles out the money for whatever is being repaired. That's obviously problematic if you have a lender and the lender doesn't want to lend to the special purpose LLC owned by the exchange company. So in a cash transaction, and again. A lot of it is a function of the price of the replacement property and whether you need to incur any debt in the exchange. To defer all your capital gain, you've got to reinvest your net proceeds and take on as much debt as you were relieved of. There's an exception to the debt requirement, but if you're selling a piece of vacant land for $1 million and you find another piece of vacant land for $200,000 and let's say the old property is free and clear, you pay cash for the new property, then you've got $800,000 in the exchange account that you can spend on improvements during the 180-day period. The one thing you do need to do is in the 45-day window from the closing of the initial property, you need to identify both the land that you're acquiring as well as the improvements to be constructed. So you've got to have a reasonable idea at the end of the 45-day window of what kind of improvements you want to build. But I think your question was more in the nature of if I want to put on a new roof on a building, something like that.
Right.
And not, build a new structure altogether. You have to analyze whether, a roof's a good example. For example, if you had a $100,000 commercial roof that you needed done, you wouldn't do an improvement exchange. You would just close on the replacement property, take $100,000 in cash at the end of the exchange, and then use the money to pay for the roof, because under the new tax rules, the roof is fully deductible. So you have income with an offsetting deduction. So there's no point in doing that through the exchange. Now that's an exception. A lot of the other improvements may not give rise to a current deduction like that commercial roof does. Does that make any sense?
Yeah, no, it does.
Okay.
To piggyback on that a little bit, if for instance you do have to go to the bank, and the bank requires a certain amount of reserves, just given what's taking place right now, can any proceeds be used to backstop that loan if they require 6 months of reserves or a year of reserves?
Yeah, you're seeing a lot of that in the multifamily context. The lender likes to see a year of reserves, and it's sort of always been a problem with, Fannie Mae repair and replacement reserves. These are more in the nature of reserves to pay the loan, though, correct?
Yes.
To service the loan. Yeah. If you use exchange money to fund a reserve account that pays a loan, it's technically taxable. So I guess what the direction you'd try to, lean in is can you over borrow and then fund the borrowed funds into the reserve account? that's not a perfect solution, but it's better than using exchange funds to pay for those loan payments over the next 6 or 12 months. At least you can argue they came out of the loan and they didn't, come out of the exchange account or the sale proceeds of the old property. The problem with 1031 is there's all these, the idea behind it is you use your equity, to buy bricks and mortar. And whenever you're not buying bricks and mortar, whether you're funding a reserve account or whether you're paying for, a discount point on a loan, or those sorts of things, you have some potential taxability there. Whenever you're not strictly trading real estate for real estate. And that's the same concept behind the improvement exchange. You can't buy that. Back to my example, you can't buy a $200,000 piece of land and then prepay an $800,000 construction contract at the time of closing, because the IRS says you're not buying real estate to the tune of $800,000. You're buying a construction contract, which is not like kind of what you sold.
Here's a question that comes from a client, and we talked about this before, I remember, from a client who wants to use exchange funds to build on a piece of property he owns. Is there a way to do that, creating maybe a new LLC, a new partnership? He owns the land, but he wants to have somebody else build on it.
So the structure is a leasehold improvement exchange. There has to be different ownership in the relinquished property and the replacement property that you're trying to improve. So it can't be the same taxpayer. They need to be different taxpayers, and that needs, back to that seasoning concept, that needs to be seasoned for at least 6 months. So you need to do some advanced planning. And then the idea is that, after you've got, again, you own the relinquished property in one entity, let's say it's taxed as a partnership, and the replacement property is taxed as a different partnership, and it's seasoned for 6 months, then you sell the relinquished property, and you basically you construct improvements in the leasehold. So the thing that you're trading into is the leasehold and the leasehold improvements. You're not buying the land from the related party. You're buying a long-term leasehold in excess of 30 years that's been constructed, again, within that 180-day window. And so, one of the downsides of that approach is you don't get in terms of your exchange requirement of trading up in value and reinvesting your cash, you can't count the cost of the underlying land on the replacement property, only the cost of the leasehold and the leasehold improvements.
Got it. We should talk about the basic. Oh, go ahead.
No, the other thing is that's based on a private letter ruling. It's authority for in theory, it's only authority for the one guy who submitted the private letter ruling for proceeding. But a lot of people have relied on it to do that. So, what
is a private letter ruling?
It's when someone doesn't know whether the IRS will bless a certain transaction. They submit a ruling request to the IRS and have them analyze it, and then it usually costs a lot of money and takes a lot of time. You have a tax attorney submit the ruling, and the IRS doesn't respond quickly. So in most circumstances, it's not a real effective device because you don't get the information in time. But if they ultimately rule in your favor, you can rely on the private letter ruling. And in theory, it doesn't have any precedential value. Only the taxpayer submitting the ruling request can rely on it.
So it doesn't necessarily have precedence then for other situations.
Right. It doesn't. But there's a lot of people doing these leasehold improvement exchanges.
Got it.
And I haven't checked the case law lately. That may have been expanded further. So.
But let's talk about the basics in case people don't understand the concept of an exchange. You have 45 days. Talk about that process.
So the basics are you need to be selling investment property, and so I'll give you an example. I had someone who called me up last week and said they bought a fixer-upper, and they've been fixing it up for 2 years. And, it was always their intention to sell the property after they fixed it up. They didn't plan on leasing it out. So they're arguably not holding that property for investment purposes. They're holding it for resale. And, if the IRS got inside their head, they could attack the transaction on the basis that they didn't buy the property with the intention of holding it for investment. They bought it with the intention of fixing it up and spinning it. So, but again, after 2 years, a little bit different set of facts. It's one thing if you do that in 6 months and resell it. Pretty clearly, it looks like a spinner or property. If you do it after 2 years, you might be able to argue that you kind of had mixed motives and you were thinking about renting it out and this, that, and the other thing. Go ahead.
So somebody could buy, say, a house and trade into the house, rent the house out for 2 years, and then live in the house after the 2 year period.
That's a different right. That's based on a IRS ruling. It's a safe harbor that allows you to trade for investment property, and the safe harbor says that if you rent it for 2 years, at a fair market rental, you're if it's a relative, it has to be a fair market rental. But if you rent it for 2 years, they're not going to challenge whether you got into that property with the intention of, other than holding it for investment. So they'll give you the benefit of the doubt on an audit that you bought it with the intention of holding it for investment. So back to your original question, you've got to have a investment intent. So you've got to be holding the old property for investment. The historical thought is, you hold it for a year because that's been the period for long-term capital gains treatment. But, for example, if I buy a property on day one and I list it on day two for resale and I can't sell it for 2 years, I'm probably not holding it for investment. So what you try to do is, again, back to the seasoning concept, you try to season the ownership of the relinquished property for minimum of 6 months, ideally, 9 months. Then by the time you close, you've owned it for a year. So you're holding something for, investment that you haven't listed during that year period or entered into a sale agreement on, because that defeats your, investment intent argument. And then you need to document the exchange before you close. I get calls, twice or 3 times a month about people who have closed, the deed's recorded, and they're looking at the check in their hand and they want to set up an exchange. And I say, well, you're going to pay your tax. We could look at the idea of going back and rescinding the sale and starting over. But if there's a lender involved in the transaction, that's not going to work, obviously. So you need to document the exchange before you close and not afterwards. And then from the closing, you've got 45 days to identify up to 3 properties. The secondary rule allows you to identify more than 3 properties, provided that the total value of all the properties does not exceed twice the sale price of the old properties. So, for example, you sell an apartment building for $1 million. You can identify 3 $1 million replacement properties. That's fine. If you want to diversify into smaller things, that secondary 200% rule allows you to identify 4 $500,000 properties, but no more, because you've identified more than 3 properties, but you're under that 200% ceiling. And you don't want to exceed the 3 property rule. Most people rely on the 3 property rule during the identification period. And not on the 200% rule, but occasionally in very large transactions, you'll see the sellers, using that 200% rule if they're either, diversifying into multiple assets, or they're also taking some cash out and paying some tax on proceeds. And then you've got, so you don't want to exceed the 3 property or 200% rule, and then you've got 180 days from the relinquished property closing to close on the replacement property. And then to defer all your gain, you need to reinvest your net proceeds. And if you had any debt on the old property, you need to take on as much debt as you had. Or secondarily, and this is that exception I was talking about earlier, you can, let's say you sell something for $1 million and you've got $2 million of debt, $200,000 of debt, $800,000 of equity. you go out and you can buy $1 million replacement property with $800,000 of your proceeds, and then out of other sources, rather than incurring a $200,000 loan, you can contribute additional funds to offset that debt relief. And a lot of people choose to, do partial exchanges, which are permissible. You take some cash at closing. I've seen that a lot in the context of these Ballard and Fremont townhome deals, where the prices are bid up and they get more than they expected, and they said, I just don't want to reinvest all this money. I got $1.4 million. I was hoping to get $1.2 million. I'm going to put the 200 in my pocket.
And you pay taxes, of course, on what you put in your pocket.
That's right. Right.
Kelly,
provided you reinvest the rest.
How would the IRS take a look at something, say, for instance, an owner-occupied fourplex? Would you be able to, like for like into, a large single-family home on a trade there, as well as maybe a larger apartment building? Or I guess I'm sort of curious what different directions you could go in with something in that category of asset.
So it's a mixed-use property. If you've lived in the one unit 2 out of the last 5 years, and if all the units are equally valued, you just take the proceeds from the sale of the one unit you live in. So if, again, it's back to the example, if it's a $2 million sale and all 4 units are equally valued and you live in one of the units, you take 500 in proceeds less applicable or allocable debt and closing costs, and walk away with that money. And if you've lived there 2 out of the last 5 years, and you haven't taken an exclusion on another sale of a primary residence within the last 2 years, you get to exclude $250 again if you're single, $500 if you're married. And then what you're doing an exchange on the remaining 3 units for $1.5 million in my example.
Okay.
So that becomes the price of the replacement property. So it's a mixed use, partly held as a primary residence, partly held for investment purposes. But that's fine. You can certainly do that.
Let me go back to the 45 days. Let's suppose that I had this happen once. The reason I'm asking the question: on the 45th day, it's 11:50 at night. They can't get a hold of their facilitator. How do they submit these 3 properties to the IRS at the absolute 11th hour?
I would email it and fax it. I had a guy send a fax at literally at 12:01, and the fax or an email, and the email reader said that he claims he transmitted it, but it didn't support on his end that it was transmitted. It's got to be transmitted before midnight.
So the IRS did not allow that.
That was. I think there were other identifications. This was a long time ago. All I know is one of the identifications was submitted, right at the deadline. And it's not. I understand the difficulty and in finding property. I mean, the reality of a 1031 exchange. The IRS obviously doesn't like these, and the reason they don't like them is back in the days before the 45 and 180 day rule in the Starker decisions, there was essentially an unlimited amount of time for identifying and closing replacement property, and the IRS said we can't live with this uncertainty and open-endedness, so they went to Congress and said we need to impose restrictions on deferred exchanges, and they imposed a 45-day deadline for identifying and a 180-day period for closing. But as we all know in this business, the what you really need is 135 days to find your property and 45 days to close it. But they don't want these things to succeed, so they were successful in getting these very strict limits imposed. But back to your example, I mean, I would certainly, that guy needs to be, communicating with the intermediary, the exchange company, and letting them know that they're up against a deadline and not to see an identification. But then, but that's the way you transmit it. You can't get it postmarked at midnight, so you've got to send it by email and fax. It just has to be transmitted on the taxpayer's end by the end of the 45th day.
Let's talk about reverse exchanges and the 45-day and the 180-day concept. How do those apply? Do the same periods apply?
Yeah, let me back up and say one thing about this whole COVID thing. So we had a notice that the IRS issued. If you had a time-sensitive deadline between April 1 and July 15 in an exchange transaction, and also in other tax-related performances, but they extended the deadline until July 15 for COVID. So for example, if your original identification deadline was April 2nd of 2020, you actually got through July 15 to identify replacement property. There's also an argument right now that a revenue procedure that's used for disaster extensions, natural disaster extensions or natural disasters, is available for COVID, but no one knows when, really the start of. It's hard to analyze it because no one knows when things would start under that revenue procedure. But if you can avail yourself of that revenue procedure, so for example, if you had to identify next week and you don't find anything, I would get to your accountant or a tax attorney and have them look into whether you can extend that identification deadline by 120 days under this revenue procedure. Or likewise, if you had to close a replacement property and your lender couldn't perform, same argument. Can you extend it by 120 days?
So in a reverse exchange, how does that work?
So in a reverse exchange in Washington, what you typically do is you warehouse the replacement property because of excise tax issues. So what that means is your client enters into a contract to buy a multifamily building, and they can't get enough time to close the sale of what they own in time. So you find an exchange company, and you find a friendly lender. And then the exchange company sets up a special purpose LLC. The entity is actually called an exchange accommodation title holder, or an EAT. And so typically that LLC is owned by the exchange company. The taxpayer who owns the old property and can't close that in time lends the down payment to the special purpose LLC, and then arranges with the lender to lend the balance of the purchase price to the special purpose LLC. You enter into a series of documents, governing the reverse exchange, a qualified exchange accommodation agreement, typically a master lease, so the exchange company isn't operating the property. And then the exchange company, through the special purpose LLC, holds it for 180 days. In the first 45 days, you can identify up to 3 properties that you want to sell to use to trade into the replacement property. And then you have 180 days to ultimately close the sale of one or more of those properties. And then at the closing of those, what are called relinquished properties, the old properties that you've identified within the initial 45 days that you own, these are not things that you want to buy. They're things you already own that you want to sell. You close them, the exchange proceed, and you enter into all the standard exchange documentation for a delayed exchange, and then the money gets recycled to you as a loan repayment. So if the replacement property costs $2 million and you lent $500,000 to the LLC, the exchange company owned LLC, to buy the replacement property, you can get that $500,000 back tax free as a loan repayment.
Got it.
And then typically what you do, if you have excess proceeds, you can identify other property, or you can pay down on the loan, assuming there's no restrictions on that. And then typically what happens is that the ownership of the LLC is transferred from the exchange company to the party that owned the relinquished property. So you're not doing multiple deeds and assumption documents. You're just doing an assignment of membership interest inside the LLC. And in Washington, we always warehouse the exchange company always warehouses the replacement property, again, as I mentioned, because of excise tax issues. If you try to take title to the relinquished property, you're going to incur 2 excise taxes, one on the transfer to the exchange company and a second on the transfer to the ultimate buyer when that buyer is arranged. So, and that's obviously a big expense in part of the world. So you avoid warehousing the relinquished property. Unfortunately, there are some times, like, if you're buying a single family residence and there's a conventional lender, where that lender will not lend to the exchange companies, so you're forced to warehouse the relinquished property if you want to do an exchange.
For people,
right? Because they want to lend it to their borrower.
For people taking a look at 1031 exchanges as an option going forward, what to your knowledge, what's the success rate, and what should they be aware of before entering into this type of deal?
I think the success rate is very high because people are pretty sophisticated about them these days. When I started doing this 30-something years ago, I think that people were going into them blind and they didn't have any idea what kind of property they wanted to get. Now, sophisticated taxpayers are usually under contract to buy the replacement property before they've closed the old property, and they're well into their due diligence. So they've got a good feel whether the property is going to work out. Again, I don't want to generalize, but I think there are some people who haven't done a lot of exchanges might be more inclined to just set one up without any idea of what they're going to buy. But most sophisticated investors they don't do that. They effectively control the 45 days by not closing. So in other words, you've got and you guys see this all the time. You've got a seller who says, yeah, I'll sell, but I need a couple extensions options in the sale agreement to, accommodate my search for replacement property. I'm not going to pull the trigger because then the 45-day gun is in my head. So I'm going to have reserve the right to extend the closing a month or two in the sale agreement for the old property.
Sure.
To accommodate that hunt. But I see very few people failing at exchanges. We've got so much gain in properties in this area, and I think part of it is that. You got a huge tax liability. You don't want to pay it. But on the other hand, you don't want to be doing an exchange just to defer tax. You've got to, some people, can't, grasp this, but you want to be, the investment you're buying has to make sense for you. You want to be making a good deal on a property purchase, as you guys know. You don't want to overpay by $100,000 to defer $100,000 in tax, right?
Do you find that some people will identify a Delaware statutory trust as one of their options?
They do. The people who are tired of management, they will identify a DST, and you see DSTs that it might be a one property DST. Typically, they're multiple properties, though. They're a portfolio of properties. I closed one the other day that had 37 or 38 properties in it. So, but yeah, you're getting you're essentially buying into a fund. The returns from what I've seen are 5% plus or minus. Some of the DSTs have debt, so if you needed debt in your exchange to defer all your gain, you'd find a DST that has debt.
For those that don't know, what is a DST? For those who don't know,
a DST is essentially a trust where the Delaware Statutory Trust owns the real estate, and rather than the exchange investor buying into the real estate, they're buying a beneficial interest in the trust. They're buying a portion of the trust itself. And it's an exception to the rule that you can't buy an interest in an entity to complete an exchange. They're treated as real estate for tax purposes. So if you have, 20 investors buying 5% in a Delaware statutory trust and they're all doing exchanges, they're each deemed to own a 5% interest in the underlying real estate asset. And so it qualifies for 1031 treatment. The problem, from what I've seen, and normally you don't really see identifications of these because they turn around really quickly. If you're thinking about a DST and you've closed the sale of your property and you've talked to someone, you get moved into those replacement DSTs pretty quickly. One of the issues is there's no secondary market for buying your interest. Once you're in a DST, you're in there until the sponsor, wants to sell it. And then when they sell it, you can exchange on the back end. But in the interim, no one's going to buy your interest. There's just no secondary market for purchasing interests of DST investors. But again, a lot of people do it who don't want to be actively involved in real estate. I understand that. I managed apartment buildings in high school, law school, and afterwards, and I vowed never to own one. So.
Are there any other vehicles? I mean, we know about 1031ing, an exchange into maybe a less management intensive asset, or putting your money into a DST or maybe a charitable trust. But is there anything that sort of average investors aren't aware of that might be another method for deferring tax?
Well, you need to buy real estate. You can buy a fraction. You can buy tenancy and common interest. You're probably aware of the syndicated TIC industry that's sort of been replaced by the DST industry. But no, you can trade for any type of real estate that's held for investment. You can buy vacant land held for investment, or as we said earlier, a single family home that you want to convert into a residence after renting it for 2 years. It just has to be real estate, and it has to be held for investment. But other than the DST option, I mean, there's something called an Illinois land trust that you hardly ever see in practice. And people who are buying into syndicated arrangements or buying into DSTs. But you can certainly trade a multifamily building for Starbucks. If your goal is to, reduce management. But so again, it has to be real estate. It has to be held for investment, but it can be improved or unimproved, and it can be residential or commercial.
Hey, I guess there is one question that I am asked quite a bit. You still are obviously doing exchanges, right?
I am doing exchanges. I'm doing them through my PLLC down here at the 1201 building where I was relocated to. You've been here. That's right.
Beautiful place.
Yeah.
Right, right above the Pyramid Brewery. I mean, how do people...
The former Pyramid Brewery that is now going out of business, as you probably heard. I mean, they were very reliant on special events.
So how do people get in touch with you if they want to do an exchange? Same number?
On my cell phone or through my email address. That is the same. I don't have a website. I don't advertise. I mostly have been, handling deals for former clients. And Debbie's still involved with me, my sister, who's worked with me for 30 years now.
And that woman knows what she's doing. She's good.
Yep, she does. And I wouldn't have done it on my own without her. So, and it's the same banking relationship, the same exchange documents. We bank at Commerce Bank, and we use one thing we do a little bit differently than most exchange companies is we use a qualified escrow agreement. The state law requires a bond or a qualified escrow agreement, but if you have a $500,000 bond and you're holding $40 million and you run away, the clients don't get protected that well. So the qualified escrow agreement gives the client a veto power over the transfers. Money can't be moved out of the escrow account at the bank without them signing a withdrawal notice. And our bank compares the signatures on the withdrawal notice to the signatures on the documents that establish the account. So it's protective. It's more protective than a bond. You've got veto power, and you've also got creditors' rights protection. So it's really the way to go.
Kelly Yates, everyone. Thank you, Kelly. Thank you very much. Kelly's cell phone number, by the way, is 206-250-6658, or you can contact him by email. Same email, kelly@exfac.com. Insights, the name of the program. I'm Bob Wright, 206-619-3274.
And I am Mike Walsh, 310-383-1570.
Hey, if you have any questions about this crazy market, remember, I've seen half a dozen of these periods of economic and political chaos. Or if you'd like an analysis on your building, nobody has more experience. In a market like this, experience does matter. Give us a call. Insights. Thank you very much.